Welcome to the Wealth Renegade podcast. I'm your host, Robby Butler. Have you celebrated your financial independence today? Today, you can be so excited to get to hear from another incredible investor friend of mine that I got to know over the years through associating with other sponsors. Terence Critchlow has walked through the passive investor landscape and decided that he wants to do some of this work himself. And so we'll be so excited to cover that at the end. But first, Terence, thank you so much for being here today.
Oh, thank you, Robby. I'm really excited to be here. Appreciate the opportunity.
Absolutely. So, because of what you're working on now, you have managed to crystallize years of experience as a passive investor, but that is where you began. So, tell us, how did you first get into passive investing in private placements? How did this all begin where you gained experience enough to say, all right, I want to do this more seriously as a professional?
I guess if we step back a long time ago, I had sort of the traditional investment philosophy, right? Going to, put my money into index funds, put it into my retirement accounts, max out my 401k and my IRA and all that stuff. And then retire when I turn, 59 and a half or 65 or whenever that magic date is with this huge pile of money and draw it down. About 6 or 7 years ago, I was looking hard at that philosophy. I'm old enough that I'm getting close to being able to see the end of that path. And what I was looking at, I wasn't really happy with, right? I wasn't getting enough money there. And then if I looked at the overall strategy, okay, if I have, X dollars in a retirement account and I start drawing it down over time, there's a huge risk that you start that, and then a year later we go into a prolonged bear recession and bear market, and then your entire plan falls apart because you will actually run out of money ahead of time. And looking at that, I tend to be a very conservative investor. I tend to be very, I want my plan, I want my plan B, I want my plan C, I want my plan D. And when I looked at that, it's like there's not enough backup plans in this, right? If something goes wrong, I could basically be living on a very small fraction of what I really want to live on in the later years of my retirement. And my wife could be living on even less since women statistically outlive men. And that's not where we wanted to be. So I kept looking around. I've been involved in real estate for over 30 years, usually on the small side, because I wasn't able to scale up my investments, right? As we all know, doing single family rentals is a great way to get into real estate investing, but it's very hard to build up a large portfolio because of the amount of time that it takes, even if you've got property managers there. And so I kept looking around, I kept looking for other options. And about 7 years ago, I stumbled upon syndications. And I mean, this was holy grail of investing, right? I just needed to write a check, I would get money back. Now, of course, we know it's not that simple. There's a lot of work that we need to do in there to, vet the sponsor, do the due diligence, that sort of stuff. But that's what really got me down this path, is the promise of being able to scale my investments in a way that I didn't need to continually invest more and more and more time every time I added a new investment to my portfolio.
You talked about in looking at your previous landscape, scanning everything and saying, oh boy, it's not going the way I exactly want it to go. So you could see the end and from that reverse engineering what you currently were doing and realizing that something has to change. And yet I know from knowing you that you also have in your conservative approach a very long-term approach. You're willing to look at deals that are 10 years or more in their business plan. So how do those two fit together for you?
So I've really always been a long-term view kind of person, right? I've always been willing to take the long-term view. To me, I think that's a much smarter approach than trying to get things in the short term quickly. The shorter your time horizon, the more risk you're going to have to take to get to a particular place. And I'm incredibly risk adverse. Right? You can never get rid of risk, but I want to be able to mitigate it. And a long time horizon is one of those ways that I mitigate the risk. And so I'm perfectly comfortable taking a 10, 15, 20-year perspective. When I get to that, end point, in 10, 15, 20 years, I want to have that backup plan, backup plan, backup plan, that redundancy and that lower risk. And what I was seeing with the traditional strategy was I'm not actually really reducing my risk. I've got to take that long-term view because you can't really access money in your 401k or IRA until your retirement age. So I've got to take that long-term view. Totally comfortable with that. But there's no way for me to mitigate the risk of a recession that starts 6 months or a year after I start drawing down my account. And I make any more money at that point, right? So that was the thing that sort of drove me to how do I take that long term view, and how do I end up with where I want to be with having different possible plans for mitigating different problems that will come up over that long term horizon. Because if anybody tells you right now they can predict what the future will bring, they're lying, right?
Mhm.
You don't know what interest rates will be in 10 years. You don't know what inflation will have done in 10 years. You don't know any of that stuff, right? You can look and hope and project, but there are an infinite number of possibilities on how things will play out over the next decade. And so, how do you mitigate the risk over that long term? What is in your control? What isn't? What are the exit plans that you have versus the things you can control and cannot control?
So, in terms of quantifiables, the things you know you can measure, you've realized I want to make a shift, and this was years ago now, but you want to make a shift into private placements. You like syndications, you like owning real estate as a component of your portfolio, and you have this long term horizon. So, now knowing what you know and having invested in multiple deals from a limited partner standpoint, what type of measurables do you look for? Is it cash flow? Is it cash flow percentage? Is it IRR? Is it deal timeline? What type of measurables are high on your list?
So all of the above. My process is really I start with I understand my own investment philosophy, right? I'm a cash flow investor. I'm looking to invest in long-term cash flow deals. And so that's where I start. That in and of itself allows me to peel off and discard and not look at a whole bunch of different opportunities that come my way. From that, right, I then have asset classes that I like and asset classes that I don't, based on, again, my personal preferences and in my, investigations into those asset classes. And I have to admit, I'm a little bit contrarian. For example, I'm not a big multifamily guy. I know multifamily's been a very popular asset class. To me, I'm much more in self-storage and mobile home parks than I am in multifamily as far as things that I like. So I start by filtering out at that top level. What is the, what does the deal fit within my overall investment philosophy? Does it fit with that? And then I do look at cash flow, right? What is the cash on cash returns? What is the whole over the whole period? And that's where, you know, the deals don't really work for me. A lot of deals can be, very low cash flow and then a big sale on the end. And you can get a great IRR out of that. You can get, that sort of stuff. But cash on cash is very low. And for me, a big thing is, one of the reasons I like cash flow is I want to reduce my dependency on my paycheck, right? I'm in the tech field. These days, everybody's heard about all the layoffs in the tech field. My company personally has laid off, 30,000 people in the last 18 months. And so there is no guarantee that I'm going to have a paycheck in 2 months, 6 months, 10 months, however long I choose to stay employed. And so I need to reduce that dependency. And I can't do that on a big IRR that's going to pay off in 5 years, right? I can't feed my family, pay my mortgage with it, the promise of money down the road. I need that regular cash flow. And so that's a big thing for me, and one of the big things that I measure my investments on. And then, from there, I look at a lot of other little things. I do care about the sponsor for a syndication. I think the sponsor is one of the most important make or break it components of the deal. And so I want to look for a sponsor who has had a track record, maybe not in that particular deal asset class, but has been around long enough to know that real estate doesn't always go up. Interest rates don't always go down, right? These sort of things are not surprises to people who've been investing for 10, 20, 30 years. They are surprises to somebody who's only been investing for five, or can be, shouldn't be, but can be.
Yep,
And so, those are important aspects to me.
and they're unwelcome surprises when they show up. So the
Yes.
the methodical, the experienced investor can look ahead and go, "I remember this scenario," and the inexperienced investor goes, "Wow, I never would have anticipated a problem occurred." For you, you have made multiple syndicated real estate investments over time. You have seen the opportunity that it creates for people to pursue very individualized goals. So tell me a little about where it goes in your vision. Where do you see like the 10 and 20-year horizon for Terrence and his investments? How did the syndicated real estate world fit into that?
So this is going to get into the transition that you alluded to at the start a little bit. So I'm invested in 10 passive deals right now. One of the challenges that I see, because I've got that long-term time horizon, is that most of the deals that I've been able to find that I like are in the 5 to 6 year turnaround time, right? So there's a invest, you get a little bit of cash flow, a little bit of cash flow, a little bit of cash flow, and then get a bigger return at the end. And 5, 6 years into, let's say, a self-storage deal is when you start really getting those nice cash on cash returns. It's because you've got the inflation working for you and the rent increases working for you while your expenses stay, relatively fixed or at least on the growing slower
Mhm.
side than your income. And so that cash on cash return becomes a lot higher the longer you hold the deal. And I'm seeing a lot of deals that say, okay, well, we're going to sell it 6 years, even though at that point we're getting, an 8 or 9 or 10% cash on cash return. So I like the cash flow and the cash flow is good. And I like the diversification of being in some of these deals that I are in asset classes that I'm not as exposed to or, not as familiar with. But I really want that long-term buy and hold. Right. I want something where we're getting that cash on cash return of 8, 9, 10, 12% at year 7, 8, 9, 10, 12 instead. And so being able to break that out and create deals that have a 10, 15-year hold time built into the plan is why I'm making the move to being a sponsor, not just a limited partner. Because then I can set those ground rules, right? I know not everybody wants to be in for 15 or 20 years, but those are the people that you know I want to attract. And I think there's enough of us out there that have that long-term perspective that don't like having to reset every 5 years, go back to the low cash flow, and start building up. And then just as it's getting good, great, you have a whole bunch more money, you have a taxable event that you have to manage, and then and your returns start all over again. So being able to do that long-term buy and hold is really what's driven me into the sponsor role as opposed to just trying to refer other sponsors.
So essentially, it's a dissatisfaction with what the marketplace is providing you, with what the sponsors and the asset classes that you know and love are not continuing to create. That's making you say, "Look, okay, I'm going to do this. If no one else is going to do it, I'm going to be the one to drive it." Are there other areas of dissatisfaction that your passive investing experience has said, "All right, I'm going to set up a business to correct this issue with LP opportunities"?
I mean, that's the biggest one. I mean, right now, the world of LP opportunities, if you're tied into the community, is huge. There are a lot of people looking for money in different areas, and providing a wide variety of products. Right. For me, the closest thing I found for what I want is some of the long-term agricultural plays, right? Where
Mm,
you go, you know, participate in an orchard or something like that, where it takes 25 years for the trees to mature, and over that lifespan, you're getting regular cash flow over time, for example, is one of those, nice long-term deals. But in the areas and asset classes that I'm most interested in, it's all short-term focused. And I understand why, right? I mean, most deals are structured for people who either don't want to hold, an asset that long, or are set up so that the sponsor doesn't get any benefit until they sell the product and they get the big win at the end. And that's a perfectly legitimate business model, but it is not the one that I'm looking for as far as my personal philosophy goes.
it's amazing. So, for you, the listener, you're hearing someone who has enough experience to recognize that there's a gap in the marketplace, and they are and And Terrence is ready to fill it with a way to offer an investor who is just like him the right fit that lasts true long term. And there's a gentleman who's been interviewed on this podcast as well, who has even more gray hair than anyone we know, who says those were the deals that performed the best over the longest term. The people who were saying, sir, it's time to exit this deal. Why are you waiting? And yet they would get not only cash flows, but they'd get true refinance events, not just 3 year, hey, painting carpets and here's your refinance event. You're now an infinite return, but refinance event. And then 5 years later, another refinance event, maybe another 10 years and another refinance event, but still maintaining what Terrence is describing, that incredible cash on cash return, because you're in it. You're already in the game. So you're not cutting the edges off the deal with transaction costs or with friction of finding new operators or perhaps stumbling along the way. So, Terrence, if people want to follow you more, where should they look you up? How can they keep in touch?
The best way to get in touch with me or keep in touch with me is on LinkedIn. I'm fairly active there. The other place is you can go to my website, nbc-ra.com. I've got a blog there that I update every couple of weeks with a new article. And there's also a free ebook you can get on why I think syndications are a great investment.
Awesome. Well, thank you so much for sharing a wealth of experience with us. And because I know Terrence so well, his own story and his motives for doing what he's doing make him truly unique. So be sure to go read his blog and keep in touch with him. Thank you so much, Terrence.
Thanks for having me, Robbie. Really appreciate it.